Welcome to The Explainer. Today, we're digging into a question that's on everyone's mind in the housing market. Using some fresh data from Q2 2025, we're going to figure out what role investors are really playing when it feels impossible to buy a home.
You know, if you've been out there trying to buy a house lately, I'm willing to bet you've asked yourself this exact question. It feels like you're not just up against other families, but these big, faceless investment firms with deep pockets. But is that what's actually going on? Let's dive into the numbers.
Okay, first things first, let's set the scene. The housing market's been in a bit of a slump, right? But it feels like one particular group isn't just getting by, they might actually be getting a leg up.
And this is really the heart of it. For the average person, things are tough. Budgets are stretched thin, the economy feels shaky, and a lot of folks are just stuck on the sidelines. But investors? Well, they're often playing with a different set of rules, and it seems like they're weathering this storm a whole lot better.
So, talk is one thing, but what does the data actually say about their influence? This is where the story gets really interesting.
All right, check this out. This is the first really key piece of the puzzle. While the entire housing market slowed down with sales dropping by 4.2%, look at investor purchases. They only dipped by 2.7%. Now, that might not sound like a huge difference, but it's massive. It means as the pie got smaller, their slice of it actually got bigger.
And because of that smaller dip, their total share of the market shot up to 10.8%. Just to put that into perspective for you, that means right now, more than 1 out of every 10 homes sold in America goes to an investor. That is not far off from the peak we saw back in 2022.
And this trend isn't spread out evenly. Oh no. In some cities, it's a completely different ballgame. Take Memphis. An incredible 1 out of every 4 homes is bought by an investor, a quarter of the market. And you see similar stories in places like St. Louis and Kansas City. That is some seriously fierce competition for regular buyers.
And this isn't just a number on a spreadsheet. It has real-world effects. As chief economist Danielle Hale says here, when you get that much investor activity focused on specific neighborhoods, it just pours gasoline on the fire, making already competitive areas even harder to get into.
So it seems simple, right? Investors are just buying up more homes. But hold on, because when you dig a little deeper into the data, you realize it's not that straightforward at all. Turns out, investors are playing 2 completely different games depending on where they are.
It's actually a fascinating paradox. When you look across the country, you see investors paying these huge premiums in some states, while in other states they're getting houses for an absolute steal. It's a totally split strategy.
And this chart just illustrates the 2 extremes perfectly. On one side, you've got a place like Montana, where investors are paying a massive premium, over a third more than the typical price. But then you look at Michigan, and they're getting homes for more than 50% less. So what gives? Well, it suggests totally different playbooks. In Montana, they might be snapping up luxury vacation spots, while in Michigan, they're probably targeting lower-priced, maybe even distressed properties.
Okay, so if investor behavior is all over the map like this, paying top dollar in one state and getting huge discounts in another, are they really the main reason prices are so high for everybody else?
Well, according to senior economic research analyst Hannah Jones, the answer is no. While investors definitely play a part and they have an impact, they're not the main villains in this story. There are much bigger forces at work.
So here's the bottom line. The 2 things that have a way bigger impact on what you ultimately pay for a house are pretty simple. First, mortgage rates, basically the cost of borrowing money. And second, housing supply, just how many homes are actually up for sale. These 2 are the real heavyweights in the market, much more so than investors alone.
So, knowing all that, where do we go from here? What can we expect to see in the near future?
Well, analysts have a pretty clear theory. Right now, mortgage rates are high, which keeps a lot of regular buyers on the sidelines and gives investors that edge. But the moment those rates start to ease up, maybe as early as next spring, those buyers are expected to come flooding back into the market. And all that new competition should naturally push the investor market share back down.
And for investors themselves to really ramp up their buying again, the whole financial equation would need a major shift. We'd have to see either a big drop in interest rates, which makes borrowing cheaper for them too, or a big jump in how much they can make from rent.
So, this all leaves us with one final big question. The data shows investors aren't some single evil entity, but their presence absolutely shapes local markets. As our economy keeps shifting, the real puzzle is this. In the housing market of the future, how do we strike a balance between a home as a place to live and a home as an asset? That's the question we'll all be watching.